Okay, guys, today, oh my gosh, here. Today we will discuss about IFRS 15, and that is about revenue. And today lecture, I'll just give the brief history about the IFRS 15, and then I will do some flavor that how to recognize the standard revenue according to the standard. Okay, in this chapter and this standard, let me zoom it. You will see here. We will discuss about revenue, overall principle and importance of revenue in the financial reporting. Then we will discuss about investor perspective, which is very important. Is we are reporting to the investor, so we have to consider the investor perspective that focusing on how investor view revenue as a critical performance measure. And then we'll discuss about revenue recognition. There are 5 steps, one by one, in detail. And then we'll discuss contract modification, that how change in contractual affect revenue recognition. Then contract cost, treatment of costs anchored in fulfilling and obtaining the contract. And then at the last we will discuss about presentation on the first statement of financial position, and then disclosure, and then judgment. Okay, so let me start from here. And this is okay here. Okay, you see here. Now let's start from the definition, that what will be the revenue and what will be considered revenue when we earn income. So revenue is actually income earned from the entity normal trading or operating activity. Okay, so revenue will be the income that you earn from your normal trading, from your normal business, or from operating activity. This means that it includes income from selling goods or services, and it will exclude other type of income, such as gain from selling long-term asset. If you are doing a business of pharmaceutical, you have pharmaceutical company, so if you are selling the medicine, then that will be your revenue. And if you, or let's say you have car, and you just sell that car and you get a money from that car, then that will not be considered revenue, because this is not your normal trading. Clear? So it means that let's say you have a store, and you are selling 10,000 worth of product, so that will be revenue. Now if you are selling old office furniture for $500, then that will not be considered revenue, because this is not your normal trading. Now we have discussed about the exclusion, that what will be excluded from the revenue. So I have told you that non-current asset for sales, let's say proceed from selling asset like building, machinery, or equipment, or not revenue. These are classified as other income or gains. So for example, selling a company own delivery van for $8,000 is not considered revenue. And then, and this will also exclude some sale tax. Sale tax, we'll discuss this later. First, you see here that revenue must relate to the core business operation. So this is all about the core business operation. The income generated from your core business operation will be considered your revenue. Means selling goods, providing services, that will be that is your core business operation, and that income generated from selling goods or providing services will be year revenue. And revenue, we recognize that in the statement of profit or loss. So when you recognize, then that will goes to the statement of profit or loss. Clear? About exclusion, we have I have told you that proceed from non-current asset like equipment that will be excluded from revenue, and we also exclude taxes like sale taxes or VAT. This means that revenue should not include amount collected on behalf of the government, such as sale taxes or VAT. For example, if a product sale for $100, okay, and this include $10 of sale tax. So your revenue will not be 100, but it will be $90 because this amount should be excluded from your revenue. So the focus is on regular operational earning, not incidental or exceptional income. Clear? So the point we have here is that revenue figure should focus only on the entity core business activity, or operation. And the second thing that we must ensure that we are not including sale of non-current asset or equipment or sale tax. So when we are doing this ensure user of financial statement, to get a clear view of the business operational performances. Clear? Now let's move on. We have to discuss the investor perspective on revenue. Importance of revenue, that why is revenue important? So revenue is a critical metric for evaluating the entity financial performance. So this is just a measurement indicator that show the financial performance of the business. It helps investors assess the market share, calculate key ratio like gross profit margin, and revenue as well understood and widely used by user of financial statement. So this is actually the importance, the importance of the revenue. Let me elaborate. It means that revenue is a key indicator of a business performance, financial performance. So this is we mean by this is the key indicator. By revenue, you will understand the business financial performance. So this is the key indicator. Revenue is used to assess market share and calculate the financial ratio like gross profit margin. You see, and the formula of the gross profit margin, then there is a revenue figure. Clear? So if a company, let's say with a 1 million dollar revenue and with a 40%, okay, gross profit margin, and we have another company that is let's say $500 revenue and 30% margin. So a company with a 1 million and revenue and 40% gross profit margin is likely performing better than one with a $500,000 revenue and 30% margin. So revenue show the financial performance of the entity. So the entity, there are some other indicator which we'll consider, but now we're just talking about the revenue, that what is the importance of revenue. Now let's move on. That is the importance. Now what were the issues with the standard before that was a standard that was called old standard, that was called IS 18. and now this IS 18 is replaced by the IFRS 15 revenue. Okay, but what was the problem with the IS 18, that this IS 18 is replaced by the IFRS 15? So the first criticism, if you see here, there's some criticism because it had a hard principle that was complex and difficult to apply. So there's some principle in IS 18 that was difficult to apply, and that was too complex. There was, insufficient guidance regarding the complex transaction, and these many accounting scandals occurred due to revenue manipulation, exposing its weakness. So these are the three key areas. These are the three problems because of which the IS 18 was replaced with IFRS 15. The first one is the principle was too hard, and that was complex and difficult to apply. The second view was insufficient guidance, especially for the complex transaction, and there was, accounting standard, and that standard was occurred due to the manipulation and the revenue. So the criticism was just, hard to apply the complex transaction, suitable only uh, for, for simple sale like retail store selling products. And then there's also some lack of guidance for complex dealing, such as subscription or bundle up. If you see here nowadays, there is Netflix and some other company that provide uh, subscription services for the year, and for that you have to recognize the subscription revenue over the period. So due to the insufficient guidance for the complex transaction, the IS 18 was replaced by the IFRS 15, and we will discuss in IFRS 15 that how to recognize subscription and other technical support services. And the third one is there is a IS 18 allowed room for the manipulation of revenue, and that was leading to the accounting standard scandals. For example, a company might recognize revenue earlier for service to inflate profit, even though the service isn't fully delivered. So when you are taking subscription of Netflix, that it means that you have to recognize the supplier will Netflix will recognize the revenue over the period of time. Means that for 12 months they have to just split the revenue service among the the 12 month, and will recognize for each month the services when the customer use it. Then we'll discuss the development of IFRS 15, that why the IFRS 15, why the standard was emerged, and why change was needed. So we're just talking about that need for the new standard. Why, if you see here, the weakness in IS 16 is actually the need for the IFRS 15. This standard was issued in 2014, which replaced IS 18, that provide a comprehensive and robust model for the revenue recognition. And we have to follow some steps. There are 5 steps, and these 5 steps we will recognize the revenue. 4 and 5 steps. We'll discuss this in the next lecture in a very comprehensive way and very detailed. Okay, then aims to standardized revenue recognition of this. Usually we're talking about this, that we need to recognize the revenue properly, and this recognition will help enhance the comparability of the financial information, and this will help the investor to take a better informed decision. So a growing complexity in the transaction, like software licenses, long-term construction contract software. If you see software licenses, long-term long-term construction contract, we need IFRS 15 for the proper recognition of revenue. Then there are some scandal highlighted that need to be handled in a proper and a strict way. So for that we need the new standard. As software companies offering yearly subscription, which we have discussed earlier, that like Netflix, and this subscription need to be clear guidance on how to recognize the revenue monthly instead of upfront. So you have to recognize the service over period because the consumer are using the service not uh, at one time, but they will simultaneously use the service, and you have to recognize in that way. Clear? So the IFRS 15 is actually a better revenue standard issue, and 2014 I have discussed this, and this will give a comprehensive detailed rules for recognizing revenue and improving consistency and comparability between the companies. Now let's discuss the step that we will follow to recognize the revenue, and there are 5 steps which you have to be clear with that. The first one is identify the contract. You have first to identify the contract, that there is contract. Then you will in the contract you will check that there is performance obligation. So once you identify the contract, then you will check the obligation, the performance obligation of each party. Then you will go and check the transaction prices, that what the transaction price is, and then allocate that transaction price to the performance obligation, and at the end you would recognize the revenue. So this is the 5 step. First you have to identify the contract, and the contract you will identify the performance obligation. Then you will determine the transaction prices. This transaction price will be allocated to this performance which is in the contract, and then revenue recognized. So identify the contract, ensure that there is a valid agreement with enforceable rights and obligations. So one party has the right and the other one is obligation. So if there is a valid agreement, then it means there is contract. Once you identify the contract, then you will go and check this determine the destined goods or services. We'll discuss this in later. Their promise within the contract, you have to check the performance obligation, and then each distinct obligation will be recognized. So if there's distinct obligation, distinct goods and services, you have first to identify, and then you have to separately recognize them. Then transaction price, so establish the amount of consideration, mean the payment expected to be received. So consider any variable amount, discount and bonuses. Clear? And then you will have to allocate the transaction price to the performance obligation, and that will be based on stand-alone selling prices. And at the end you have to recognize regard revenue when or is the performance obligation is satisfied. So will you recognize the revenue when the performance is the performance re-satisfied. Okay, the performance may be satisfied over time, then you have to split or gradually the services provided gradually, so you have to record that revenue and that pattern, and it find in time, so the good service delivered, so that time you have to recognize the revenue. Clear? Let's just check the illustration and then we'll wrap up with Okay, here. Now you see here, illustration of principle. So a company sign a contract to deliver 10 laptops and provide 1 year of technical support. You see here, this is the agreement, this is the contract, and the contract is about 10 laptop and provide 1 year of technical support. So these identify the contract. The contract is about laptop and support services. Separate performance obligation, that is laptop. The company have to provide 10 laptops and then also to provide a technical support. These are the testing goods and services. Okay, price is let's say the total amount in the contract is 15,000. Here I have written, and this 14,000 for laptop. This is the standalone selling price, and 1,000 for the support, technical support. These are the standalone selling prices, individual price. Now allocate the prices of putting to the laptop. This is the laptop is delivered at a time, so you will have to recognize that time, and the service will be provided for the 12 months, so you will divide the service cost by 12 months. So each month you have to recognize the revenue of support. Clear? Now here is example. You see here, apply the five stage of revenue recognition. IFRS 15 to determine how much revenue W should recognize at the year end 2001. Okay, so here we have a question, we have illustration. We have to just follow the 5-step rules, and then we will recognize that what is the amount of revenue. Clear? On 1st December, W received an order from a customer for a computer as well as 12 months of technical support. So the contract shows that there is an agreement between the contractor, the supplier, and the customer. That the supplier will provide a 12 month of services and will also provide a computer. So this means that contract exists between the W and the customer for the computer and technical support. Clear? Now W may supply deliver the computer and transfer its legal title to the customer on the same date. The same date means on the 1st December 2001. So the computer is delivered in the same date on the 1st December 2001. That's the performance obligation which is performed. So the first step was to identify the contract, and the contract was identified. They have to provide a computer and the technical services. Now we have to identify the performance obligation, the performance PO, the performance obligation. The performance obligation is the supply of computer and a provision of 12-month technical support. Clear? Now the third thing is to determine the transaction price. Now the customer paid 420 upfront. If sold individually, the selling price of computer will be 300 and the selling price of the technical support will be 120. So the transaction price is 220. Clear? Now we have to allocate the transaction price, which is 240, to the performance obligation review. And we know that based on the standstill selling prices, computer price will be $300, and that of the technical support will be 120. So allocation remains will be 300 for computer and 120 for technical support. Now this is the standalone selling prices. We have allocated the transaction price to the performance obligation, which is computer and support. Now we have to recognize revenue. Okay, the computer is delivered on 1st December 2001. So the control is transferred and we have to recognize a revenue per computer 300 on the same day. Okay, and this is talking about 31st December 2001. So there's a 1 month service already consumed. Now the technical support is 120 for fill month. So we want to take only 1 month. If you divide this, then you will get $10. So this will be recorded. This will be recorded at 31st December 2001. This means that computer amount 300 recognized and the timing on the 1st December 2001 at delivery, because that was delivered at the same time, same day. And the technical support of $10 amount recognized over times and then $10 recognized in December. The remaining will be recognized in the upcoming month. So for today, we have just discussed the flavor of recognition of revenue, then discuss some history of revenue. We will continue in the next lecture. Thank you for watching.